Very good afternoon. Welcome to Mid Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vivek Iyer. Well, it's turning out to be a session where, yes, we have recovered from the day's low, definitely. So in the green for the markets, we have the Nifty, which is up around 44 odd points. And we have the Bank Nifty, which has recovered significantly as well in today's trading session. So good going with the mid-cap index up around 0.2% as well. So green on the screen, advanced decline ratio still on the declining side. So let's see whether or not it favors the advances as the day goes on. But as of now, looking good.
Good afternoon, Ekta. Absolutely right. A smart recovery in the second half is what we are witnessing so far. We have a lot lined up on the show. Many important managements post Q2 and an important IPO too that's opening up. So let's start off with the top headlines. Stocks open with cuts but stage a recovery even as global cues remain positive. PSU banks and realty under pressure while IT and autos eke out gains. Mid-caps in line.
Vikran Engineering surges after reporting its Q2 numbers. Consolidated revenue surges nearly 11% while margins expand.
HCLTech under pressure despite reporting a decent set of Q2 numbers. The company saw its net interest income jump 17.5%. Management tells CNBC-TV18 that they are well on track to achieve net interest margin of around 3.3% by the end of FY26.
Car Trade Tech confirms CNBC-TV18 Newsbreak as the company states they are in talks to acquire Car Dekho and Bike Dekho. Stock, however, slips almost 6% from intraday highs.
Vodafone Idea surges over 8% as losses narrow in the second quarter. The ARPU also rises by over 1% sequentially. Well, welcome to Mid Cap Radar. Like we've been speaking, it's a sharp recovery that we're seeing. An important IPO is around the corner. MV Photovoltaic Power's IPO has opened for subscription earlier today, and the company is looking to raise close to 2,900 crore rupees via the issue. To discuss this and more, we are joined by Suhas Donti, who is the whole-time director, president, and chief executive officer at MV Photovoltaic Power. Thank you so much, Suhas, for joining us, and we wish you all the best for the ongoing IPO. First up, break up the usage of the IPO proceeds for us. We understand close to 2,900 crores is what we are raising. How much are you looking to go ahead and repay the debt in your subsidiary? What will be left after that? And pre and post listing, what will be the debt on the books?
Yeah, thank you very much for having me on the show, and it's a pleasure to be here today. Before I get into the use of proceeds, I'll just take a minute and talk about the background of MV. We are India's leading solar module and cell manufacturer, so we are an integrated player who is second largest in the country today. And we have manufacturing experience of 18 years and been a profitable company.
Suhas, a lot of the information you're giving us is flashing on the screen for our viewers. We are a little short of time, lot of earnings. If you could just come down to the details itself.
Sure. Absolutely. So our issue size is 2,900 crores. Out of that, 2,150 crores is the fresh issue, and the balance is the OFS portion. That's 750 crores. So out of the fresh issue, we are repaying the debt of 1621 crores. And today, our long-term, that was the long-term outstanding debt in our balance sheet. And the remaining will be the general corporate purposes, which is about 530 crores.
Okay. All right. Just give us a sense, just line up the capex for us. It seems to be quite ambitious. So if you could just reiterate it for our viewers. And how exactly are you going to fund it? How much of, say, the IPO proceeds is going into capex?
Yeah, absolutely. So we have a 7.8 gigawatt of module capacity and 2.94 gigawatt of cell capacity. We are adding another 2.5 gigawatt of module capacity that is going to get completed in this year. And there is an integrated capacity of 6 gigawatt of cell and module, which will take our capacities to 16.3 gigawatt of module and to 8.9 gigawatt of cell. So that is the 6 gigawatt of integrated capex that we are talking about. That is totaling of 5,500 crores of capex, out of which 60% is the debt that we have secured from IREDA, our long-term lenders. That is 3,300 crores of debt, and balance will be funded through internal accruals.
Understood that. So now, you've spoken about the capex plans as well. Now, going forward, what is the sustainable growth rate for a company? Because looking at FY25, of course, it's been a very, very sharp jump. Going forward, sustainable growth rate, will you grow in line with the industry? Will you go faster than the industry? The reason we're asking is that there has been significant competitive intensity that is ramping up. So in that backdrop, can you grow at the same rate that you've grown past?
Absolutely. So, given our 18 years of manufacturing experience in this industry, we have seen many cycles, right? And if you look at our growth of revenue or margins per se, if you look at the revenue, it is growing with the capacity that is being added. So the reflection of the capacity addition is shown in the revenues. And EBITDA growth is backed by the backward integration the MV has done in 2024. So we commissioned our first cell manufacturing facility in September 2024, which gave the rise to the EBITDA and the profit margins in FY25. And that is continuing to reflect in the first quarter of FY26 as well.
Okay. Just wanted to get a larger sense, Suhas, that, what exactly are you anticipating in terms of returns? For example, are the peak returns behind in the industry simply because of the kind of competition that we're seeing? We have bigger players entering the industry as well. At this point, what's the competitive landscape for your like?
No, wonderful question. And I think, again, right, given our experience in manufacturing and being one of the first manufacturers of TOPCon cells in India and having one of the largest capacities of TOPCon cell manufacturing in India, we have always been at the forefront when it comes to technology, quality, and product availability in India. So, given that we have a strong acceptance of our products by the large-scale developer community, and key accounts make up a large chunk of our revenue. And given that position, I think the company is in a very strong position even going forward, and we hope to continue at the current levels of profitability as well as EBITDA, given the standing of the company in the industry.
Okay, Suhas, thank you so much for joining us. We wish you all the best for the IPO. A short conversation, but we invite you once the listing day, and we hope to get a lot more concrete details in terms of the financial aspirations that you hold. But moving on, we'll now slip into a short break. Manish Gulati from HEG joins us next to discuss their Q2 numbers and more.
Welcome back. For the markets, it's turning out to be a steady session now. So up around 52 odd points currently for the Nifty, and we have the mid-cap index, which is up around 120 odd points as well. But let's talk about one specific company. HEG is in focus. It posted what was a good set of Q2 numbers. The company's revenue grew around 23%, while the net profit surged too. To discuss the quarter gone by and the way forward, we have with us Manish Gulati, who's the Executive Director at HEG, to join in to discuss more on this. Mr. Gulati, thank you very much for taking the time out. Well, the revenue growth was around 23% this quarter. Just give us a sense in terms of what the utilization levels were and how did it compare with the industry? Because earlier you've said that utilization levels can get to around 85%. What was it this quarter? How does it compare?
No. For the 2 quarters gone by, the Q1 and Q2, our capacity utilization has been in the excess of 90%. And the revenue growth which you see quarter on quarter, Q2 versus Q1, yes, we have sold more in Q2 compared to Q1, which you can see in the top line. And through the year, we hope that we should be close to 90%, as compared to the last year, which was close to 80%. So, and if you compare it with the peer group, I can safely say that our capacity utilizations are better.
Okay, so Mr. Gulati, you're outpacing your peers, especially in terms of capacity utilization. Can you give us a volume growth guidance for FY26? And have you been selling, the higher volumes Q2 versus Q1? Has this been done at a higher realization?
First, when it comes to realizations, they are, I would say, they are still at the same level. The top line growth, which you see, is mainly because of volume, higher volume sold in Q2 versus Q1. And if you ask me to compare the last year volume growth versus this, so the last year it was close to 80%, and FY26, we hope to be close to 90%. For the first half, it's more than 90%, it's 90 plus. So I think by when the balance 2 quarters are done, we should be close to 90%. So that's the kind of volume growth. But as I said, the prices are still stagnating for the last 2 quarters.
Okay, so prices are still stagnating for the past 2 quarters, but you are expecting a volume uptake. Those are the Bajaj FinServ numbers. The revenue is up around 11%. That's obviously Bajaj Finance plus the insurance arm in terms of the numbers that FinServ is reporting. Net profit is up around 7.5% to 2,244 crores. More details in terms of the internals, but as you can see, both the twins have been on the downside in today's trading session, primarily reacting to Bajaj Finance numbers. But Mr. Kolati, just getting back to the conversation, if you could give us a sense in terms of how the graphite electrode prices have moved. Prices were expected to be flattish in Q2. How exactly have they moved? And what is the way forward?
Prices have been quite flattish between Q1 and Q2. And although we were expecting prices uptake in the second half, but it's still taking time with the kind of steel production we are looking at. There's still a decline in the first 9 months of calendar year 25 to 24. If we compare, there's a decline, 1.5, 1.6% decline. And even if we exclude China, it's very, very flattish for the markets we cater to. So we are hoping that in quarters to come, 2-3 quarters later, when the steel production starts to show growth, and ours is derived demand from steel production, particularly from electric arc furnaces. So the demand for graphite electrodes should go up. And the new electric arc furnaces, which are coming, which we can see, they're under construction. About 11, 12 have come. 20 million metric tons is expected soon in the next 1.5 years. So we are hoping that in times to come, there'll be an uptick in demand.
Understood that. Give us a sense, you said that you're hoping for an uptick in demand. Give us a sense of the impact that the US tariffs have had, especially as far as the export order book is concerned. We understand 10 to 12% of the total production goes there. So despite the fact that you've been operating at 90% plus capacity utilization, has exports continued to remain a headwind?
Well, we are also watching the situation, and we are hoping that the tariff of today, 50%, settles down to a more reasonable level as it has been settling down with other countries. So that's what we are looking at. 2025 is almost getting over. And 2026, we hope that in the next 1 month, 2 months, 3 months, it settles down and our sales continue as before to US. Even if it is not, as I've said in the past, that our markets are very well diversified. We are dealing with supplying to almost 35 countries. That includes Europe, Middle East, Southeast Asia, almost everywhere. And US accounts for 10 to 12% of our sales. So we are, I think, quite geared up to handle the tariff situation. Of course, it's a very important market for us.
Okay, all right. More on that later, Mr. Kolati. We've run out of time. Thank you very much for joining in and speaking with us. So that's the management of HEG, stock up 4.5%. We'll take a break. Up next, we'll get you an exclusive conversation with the management of Swiggy. Expect 18 to 19% growth in the food delivery business. That's the word coming in from Swiggy's food marketplace CEO Rohit Kapoor. In an exclusive conversation with our colleague Shilpa Ranipeta, Rohit also adds that the company is eyeing EBITDA margins of 5% in the medium term. Listen in.
I think the guidance that we've given even to analysts and markets is in that range of 18 to 20%. And it's on a large base, so the food delivery industry is now 10 years old. Also, profitability has emerged in the industry, which is very important because the growth and profits have to go hand in hand. We do believe, though, that given what we see of penetration levels, etc., in the medium to long term, it's our job as well, because as key players in the market, as we focus more on affordability, because India will grow, GDP per capita will increase. So over a period of time, this number should move up.
Right.
Now, are we guiding to that? No. But are we working towards, just the basic fact is that there are segments where it has to become more affordable going forward. And that's a key focus, yeah.
Right, so, but then you just mentioned profitability also. Are we still sticking to the profitability timelines? At least for food delivery business, when can we expect, PAT positive?
No, we don't. We're giving EBITDA, and in this business, there's not much under EBITDA. So,
Okay.
And we had a very strong quarter on profitability. Again, we released the results about 10 days back, 10, 15 days back. We continue to guide in the medium term to a 5% EBITDA margin. And remember, 5% is on GOV. So when you compare to percentage of revenue EBITDA, it's much higher.
All right.
Yeah.
And I want to talk about Bolt, and you've also been talking a lot about affordability. Currently, how much of the orders are coming on Bolt, and are you further scaling Bolt as a proposition going forward?
See, Bolt is already scaled up. It's already double-digit percentage at our level of volumes. That's significant. I think what we have is now rich data on which consumers, which use cases prefer speed as a primary vector of choice, right? And I think we're getting much sharper in terms of making sure that those consumers see Bolt on a very regular basis. More propositions are available to them on Bolt. I think that's the focus. Speed is always going to be a vector of interest for consumers.
Well, that's the word coming in on Swiggy. They say that they're targeting 5% EBITDA margin in the medium term. But with that, it's all the time we have on this edition of Mid Cap Radar. MF Corner when we return.